Chinabank was projecting inflation for the month of July at 5.5%. Your thoughts on that 6.4 print for July?
Yes, we thought 5.8, a little bit lower than the median. Largely, our projection was based on the recent rollbacks in domestic pump prices. So that was for the 4 consecutive weeks of July. Gas and diesel declined by around 11 to 13%. But of course, this was more than offset by your increases in, let's say, transport inflation. We expected already the jeepney fare hike of 2 pesos overall for the whole nation, right? And then also sea and air transport increased substantially. I think for flights because there were higher surcharges to oil prices. And then secondly, for secondary round effects, this is becoming more broad, more pronounced in terms of food. For example, in April, we were actually seeing this in our basic food like meat and food because you have higher oil prices, transport costs increase. So for example, if you get some vegetables from Benguet, you bring it to Manila because you use transport, there's some secondary round effects, right? But now we're seeing that even in restaurants, prices have been increasing. And then I guess for this month, which is a little bit not so quantifiable, is that there was a recent depreciation of the peso. So because we have imported inflation, we're now importing more pork, more corn. Of course, our exchange rate affects this. For example, BSP estimates that 1% depreciation of the peso, it actually translates to around 0.05 to 0.1 percentage point increase. So if you look at the depreciation recently, from June to the first half of July, the peso actually depreciated by around 7%. So that feeds into your July numbers also.
Now, what then for you is the outlook here for inflation for the remainder of the year? Do you feel like inflation has already peaked this month, or do you expect it to remain elevated for the rest of the year? Are we even looking at a possible breach of 7%?
Okay, for us, we think it's going to peak around fourth quarter, possibly in October, due to higher prices. As we said, wage hikes implemented in July, transport hikes, of course, they have some effect, but all this impact of these policies are not just immediate. So, for example, when the businesses increase the wage of workers, they will somewhat absorb the costs. For example, just this July, but of course, they'll pass it on to consumers eventually. So we can see some effect of these policies still until end of the year. In terms of the figure, we think it's going to be in the high six if oil prices continue to be, I guess, stable. It has actually come down a little bit. Food prices globally has also come down a little bit. So if this one is stable, we think maybe high sixes.
Are we seeing as well pressure still largely to be supply side, or are we seeing more emerging demand side pressure here?
I guess for this year, more supply side still. So a lot of the things that are needed are really non-monetary measures, right? By next year, of course, we'll see some demand side. The economy will be fully back on pre-pandemic levels. And then in 2023, you'll have your last tranche of the train law, for example, bringing down the personal income tax of employees. So employees will essentially have more money on their pockets. So this is a little bit demand side, but of course BSP has been very advanced in monetary tightening already, right? So since monetary tightening actually works with a lag, we'll see some effect and it might mitigate any demand side inflation.